My office is in Oakley. I have two attorneys and a CPA and accountant that work with me, so we do death and taxes as the focus. Thank God for Congress that we're going to have a busy December. If you haven't kept up on the news, we're expecting the tax committee in the House and Senate to come up with their tax reform legislation. They call it tax reform, and that'll be supposedly a Christmas present December 22nd. Which gives us the last week of December to try to figure out what you really need to do to save taxes in 2017. So it's pretty simple, isn't it, right? I did want to mention that I'm going to save time for questions. And in fact, during the talk, if you have any questions at all, that'll be great. And because this is complicated and you may need some things clarified. A lot of you are investment advisors, so there isn't a lot of changes, as I would say, as far as the taxation of interest and dividends and capital gains. Both the House and the Senate versions are keeping that pretty similar. My goal here, though, in 1 hour, we can't possibly, hour and a half, go through everything that is really out there. So I've got some resources for you. And I did want to mention, by the way, the book that's there, Goal for It, is really appropriate for New Year's resolutions. That I was very honored to be part of a collection of 20 successful business people that shared your success story. So yes, as an entrepreneur, I started my business 25 years ago, the third time I got fired in my career. So, sometimes necessity is the mother of invention. I got kicked out of the nest, God bless me, and I have my story in there in chapter 13. And so it was really a miracle year in my life when I started back in 1993 out of my apartment in Fort Mitchell, Kentucky. So it's been a big journey, and that's what they say for entrepreneurs. It's not a one path that you go. It's the zigs and the zags and the ups and the downs in life. So that helps me really relate to my clients, and particularly business owners, in doing tax planning, business consulting, financial planning, and so it really is all intertwined, and so I'm really effective then trying to work with business owners, trying to sort through all the issues. So I also wanted to let you know that I have some handouts that I think you'll find maybe helpful. I've been trying to monitor this the past month when the House passed the bill in November, the Senate passed the bill early December, and so you'll find that a couple letters that I have that as financial advisors, or if whatever your profession is, you're more than welcome to share this material. If you need any email to forward it by electronic copy, I'm more than happy to contact my office, Vicki, and she can send electronic email copies of everything for you too, because it is complicated. But quite frankly, there's some very significant changes that we know are going to happen, and that's what I've kind of focused on already. You will see a letter that talks about, well, what do you do? So the first letter was about the House bill, and we sent that out. They kind of summarized, it's in your handout. So there's a letter about the House bill that summarized what the House was doing and what you probably needed to do. And then we talked about November 30th, planning for the change, not knowing that the Senate, I was quite shocked that the Senate passed the bill in early December. But it talked about what people really need to do the tax planning this year is you got to identify where you are. You have to project your income for this year. And you have to have a crystal ball. What is your income going to be next year? Any planning in taxes is only as good as those assumptions, those projections. So sometimes that's difficult. But that's the bottom line. When you're trying to do some year-end tax planning, we're going to go into some of those strategies that you would use, but it's all premised on the fact that you really need to know where you are. You got to measure, what is your income this year? What do you expect it to be? And what do you expect next year to be? Because you got to make some decisions, quite frankly. If they pass the bill by December 22nd, you have to make some decisions by December 31st. So that's why I've been really aggressive trying to push this information out. The next letter is something that I set up with I actually shared it with the Greater Cincinnati Foundation as well as Chase Law School for their capital campaign. But basically, a donor advised fund. I'm going to go into that in detail in the outline, but this is a letter that outlines, I think in really good detail, why you would want to set up a donor advised fund by the end of this year. Okay, we're going to be going into that. So that's really important. But this is a nice letter that kind of goes through and it kind of analyzes the why behind that and what kind of client that you're working with, may need to work with you as an investment advisor to set up a donor advised fund through your connections or just through the Greater Cincinnati Foundation. I also have a little evaluation sheet if you care to fill that out. We always appreciate your feedback at the end of the seminar. So I'm going to kind of get started on the basic outlines, and I wanted to mention one other thing. And again, we have a tax planning guide. Now, this is the end of the year. I ordered my tax plan a month ago, but because of the legislation, they didn't do anything. It doesn't change 17. They want to incorporate 18 into it. This will tell you the law for 17. Now, I'm really these are literally my last copies, so I strung this thing out. But you will find some very good information. In fact, I expect to be getting my tax guide that I ordered a month ago in the office within the week. And I'm hoping if you want this tax guide, contact me, contact Vicki in my office. We will get it to you, okay? We'll mail it to you. You can pick it up at my office in Oakley Square. I love this tax guide. I've been using it for years. It really has a lot of tax planning tips in it. So that's going to be the complexity, quite frankly, because there's really going to be a new set of laws next year. So this book is going to be good for this year, okay? But next year, in 2018, you're going to need to really talk to your CPA, talk to your tax advisor, whether you have a tax attorney or a CPA, and try to figure out what you need to do. And one thing that is kind of amazing, I've been doing this for so long, I try to do tax planning for 18 the beginning of the year. It's almost too late when you try to do some things the end of the year. Now, there are some last minute strategies we do implement the end of the year. So my message to you is that when the law comes through, we will be doing not only planning the last of December for 17, but we'll start doing planning for 18 the first part of the year, especially for business owners. So I'm going to be going through some tips of what you should be considering. So this program initially started out, I'm going to go to the first outline, the top 10 tax planning mistakes that business owners make in planning their taxes. I started this program 4 years ago, and I've been developing it every year. I'm doing it again, so just so you know, you may want to put on your calendar that I will be having a seminar February 8th at the Northern Kentucky Chamber of Commerce from 8 o'clock in the morning to 11:30, covering tax planning, succession planning, and estate planning. I'm hoping to know what the law is by February 8th. So that will be a little bit different presentation because I will hopefully have more relevant information and hopefully have a month to absorb it so I can have that presentation on February 8th. It'll be at the Northern Kentucky Chamber of Commerce. So I did want to go through this outline here because it was very effective, and I think it talks about us here as business owners primarily, but there are some individual changes we'll be putting into the second outline, which talks about the new tax law and what you need to do as a result of the new tax law. But the first step in tax planning, quite frankly, is you need to know where you are. And that's point number one. I try to focus on this with clients because particularly business owners, they don't really understand what their tax bracket is. I'm talking about tax bracket. So if you go to the middle of the outline, there's some numbers of pages. At the bottom of the page it says 2 of 5. And it talks about, the heading is manager-managed LLCs and member-managed LLCs. But at the bottom, it shows you if you're married or single. It shows you, this is basically the rates today for 2017, that if you're married and your taxable income is between $75,000 and $150,000, your federal, all that income is taxed at 25%. Okay? Now, if you are self-employed, whether a sole proprietorship, a partnership, you pay Social Security taxes on all of your earnings, your self-employment earnings, at 15% up to $128,000, okay? And after $128,000, you only pay 3%. So a lot of the income, if you're married from $75,000 to, if you're self-employed, from $75,000 to almost $130,000, is subject to tax, Social Security taxes at 15%. So a married couple that's this middle America that's trying to get ahead in life, the government's taking 40% of your taxes, okay, on any dollar of taxable income you make between $75,000 and $130,000. That's where most people are, quite frankly, business owners I work with. And when you have that realization of how stiff the taxes are, it gives you a motivation to say, whoa, because that's only half the story. If you're in Kentucky, the tax affected to 4%, and then you got city taxes at 2%, you can have a 46% tax bracket at the end of the day, okay? And that's not a lot of income. You're not the rich, that's earning this. I have clients that you have, the one spouse working and the other spouse is trying to go to work, start up a business, make extra money so they can pay for their kids' college, or they're trying to save for retirement. And you get slammed in taxes if you got to budget it. Because I had that happen to so many clients, so they get so blindsided. They make $10,000 in profit the first year and they got to pay almost $5,000 in taxes. Okay? And the single person isn't any better, quite frankly. When you look at the single person, their 25% bracket, this year, is between right around, I'm going to say 40,000 and 90,000. So you're single. So I had a hairdresser that was making $60,000 doing hairdressing, and her taxes were $20,000 when you added it all up. Okay? So I try to educate my clients to understand how important it is to do tax planning. It hits your pocketbook. Okay? And they need to budget for it too. So I always talk to clients, typically, if you're starting out a business, budget a third of your income for taxes, at least. It depends, because if you're in some situations, you almost need to budget 50%. If you're in that scenario where your spouse is in a higher tax bracket, and anything you make gets killed with taxes and Social Security taxes. So the minimum is 33%, is what I tell business owners starting up. So when you understand that, you say, well, okay, as a tax advisor, I can't say, you don't report your income. That doesn't work, okay? We can defer income. We can do some tax planning that we do that. But what's really important is to maximize your deductions, to understand that you're taking all the deductions you can take so that you minimize your tax to the best that you can. That's the game. I've been doing this for 40 years. And I enjoy it because there's so much misinformation out there about what you can and cannot do. Everybody hears something about the country club. I'm doing this, I'm doing that. Sometimes they call it the audit lottery. You're doing that? You better not get audited, okay? So it's important to have and again, I kind of see this all the time. I'm in practice with lawyers and attorneys, and actually I used this line when I was testifying as an expert witness in court one day, that they were challenging me, well, how could I express an opinion on, there was a real estate appraisal down at the stadium. My client had a parking lot that they wanted $5 million for them to take it, and the city was offering $700,000. And so after the lady, the prosecuting, well, I should say not the prosecuting attorney, but the city of Cincinnati attorney was grilling me by why I thought I was competent to express an opinion about real estate. And I said to her, well, it's quite clear. I've been in practice all these years that I have so many attorneys and CPAs that have the name, those letters behind your name, and they're not competent at all. And the jury laughed. And I said, the letters behind your name, you have doctor, and what do you call the doctor that was last in his medical school class? Doctor. And all these jokes are out there that there's a lot of good apples out there, but quite frankly, there are some people that it's kind of scary that they're not really that competent, and I see that on a regular basis. So I think it's important. I'm trying to emphasize that you work with. There's a lot of good CPAs out there. There's a lot of good firms. There's a lot of good lawyers out there, and that's what you want. You want to find somebody good to work with. That's the message. Okay. So then we go in and. So that's the mistake number one, is you just don't know where you are, okay? And then number two, I learned this a long time ago, the failure to set up your pension, your 401k, your simple retirement plan, for business owners, a cash balance plan. There's a lot of really good, effective retirement plans that allow you to basically tuck away money. Now, you might have to pay Social Security taxes, but you can maximize what you do whether it's a simple IRA or a 401k, and so what I do when I work with pension design with a business owner, I try to identify how much do you want to put away. That's the first question you need to ask. How much are you willing to put away? Because I'll tell you, the first place I look on their tax return, I look on their investments and find out how much interest and dividend income do they have on their tax return. You know what I see most of the time? None. They don't have it in their budget. Everybody is outspending their income 10% at all walks of life. So, it's nice to come out here and say, well, you can save taxes if you put away $30,000. They go, well, where's that $30,000 going to come from? I got 2 kids in college, I got my house, I got, everybody's got the house mortgage and the 2 cars that, are just killing them. The financial planning is very inadequate out there. Then most people live above their means, okay? So when I'm doing retirement planning strategies, I got to really focus on what they can really afford to tuck away, because that money has to be invested. And when I look on the tax return, I'm finding that most people are spending everything and are going into debt, okay? But it is an effective tool if you do find the clients that are being fiscally responsible and are able to put money away. And even the cash balance plan, I had a client that, he's just went into business for himself, making some money, a couple $100,000 a year. But his 401k, he can only put in $18,000, and he can't get, actually he did a strategy. He's an S corporation, so he's only paying himself a $60,000 salary. So when you start putting in the profit sharing plan, you can only put in 20. It depends on what kind of class, what type of ownership you have, whether you're 20% or 25% owner. But you can't put a lot of money away. 25% of 60,000 is 15,000. So you can only put away 30, but the max could be up to 50 or even more if you do a cash balance plan. So I'm working with an actuarial company now that's consulting with him, and my message to that client was, how much can you afford to put away? And he said, I'd like to put away $30,000. So fine, that's how we'll plan. We'll design the plan to do what the client needs to do. It's kind of interesting, the same individual, I had another client that this individual was working with him, and he couldn't get it, that he wanted to max out his cash balance plan. Go, no, he doesn't want to put $160,000 a year in at age 35. He only wants to put in 50, So sometimes I have problems communicating with the people that do pension design to let them know what we need, and we're not trying to, like doctors, they can afford it maybe. They're used to just putting in the max. But most of my clients are not in that situation. So that is another important planning tool, I think. I am going to comment on the Roth IRA and the Roth 401k and the Roth accounts. As a financial advisor and as a tax person, I studied this a long time ago when it came in. It actually came in back in the 80s when I was the tax partner at Touche Ross and before I left after the merger with Deloitte. And what you need to know with a Roth IRA is that you want to do a Roth IRA if you think you're going to be in a higher tax bracket when you retire. So think about that. If I'm in a higher tax bracket when I retire, I want a Roth IRA. Most people are not in a higher tax bracket when they retire. These tax schedules have been indexed for inflation, and under the new law will continue to be indexed for inflation. And I don't have many people that have $1 million in their account, maybe $2 million. But if you take 4 or 5% out, you're only taking out $80,000 a year on $2 million account. My point is, you're not going to be in that high of a tax bracket, I don't believe. Okay. Now, one thing that is important to know is that when you do the regular traditional retirement account that's not a Roth, then it is taxable down the road, but the required minimum distributions, if you understand how that works, because you're saying, oh, well, you want to avoid the required minimum distributions. Well, the required minimum distributions at age 70 and a half are around 4%. And if you earn 6 or 8%, typically the typical retirement account grows from this till you reach age 80, and then you start paying it out, okay? So again, one of the things that they may take away, we don't know. I do a lot of elder law planning. Clients going into the nursing home. And I try to use those retirement accounts that they tap into them. And currently we get a tax deduction on 90% of the money you spend for the nursing home. So I would rather them have more money, potentially. I don't know what the law is going to be down the road, and it may change. They're talking about one version has medical expenses not being deductible in 18. The other version kept it. I think it's going to be there. I don't know. We're going to find out. But my point is that it's an interesting that I think you're going to have more money available to accumulate if you do a tax deductible account. So you have more money available for the nursing home in your 70s and 80s. That's part of my strategy. And I work with clients all the, yes?
In relation to the tax situation, how do you answer questions of clients that have concern about the amount of debt that we have as a country and the potential that the tax laws change because of that, because that eventually has to get paid back? What are your responses to some of those things?
Well, I think the response to the question relates to that there's an argument out there that because of our significant debt, that our government is going to have to just start taking all of our money, and you're going to be on a high tax bracket, even if you only have $80,000 a year in income. I just don't see that flying, quite frankly, because the point is that the government has to take care of the poor. I think that debt is not going to be repaid. That's the response. The debt is not going to be repaid. It's going to continue growing, and indexed with inflation, I don't see it getting repaid. And you're right. Where we are, quite frankly, is potentially the collapse of our democracy. Okay, and that's studied out there. We're in the last stage. If you study some of the things about that, and they talk about that, how democracy, if you study history and democracies, history repeats itself. We cannot avoid it. Our government there'll be a major collapse down the road. Hopefully not in my lifetime, but you never know. But the whole point about that is that the last stage of a democracy is when the people vote benefits more than what the government can afford to pay them. The government fails. And we're at that stage right now. Yes?
State of Illinois. Just take a look at the state of Illinois.
You said take a look at the
State of Illinois.
State of Illinois. I mean, yeah, I'm just saying that. So my point is that I'm looking at clients that have a time horizon of the next 20 years. That's how I look at it. 30 years. Now, I don't know what's going to happen in 100 years, but I know that democracy will probably fail in 100 years. Right now, I think they have a window. They said it started, maybe around 40 years ago, that they think it's going to be 60 years. But again, these are historians, but what they're saying is not too late. And so that's the thing that is out there that we don't know what the future is, but I look at it from my crystal ball, and I kind of just play the odds. And my point is that if we get to that point, quite frankly, the government's going to fail. If they have to tax retirees at a higher tax bracket, the thing you need to know, if you're in the same tax bracket, it's a wash. So it's a mathematical thing. So if you're in the same tax bracket, there's no benefit, there's no gain. If you're in a lower tax bracket, you come out ahead. So I think that it is something that I think it's a fair question, and I try to address it all the time. That I think that from that standpoint. Another question.
Don't you feel that governments always pay their bills one of two ways, either by raising taxes or inflation? I mean, that's what they do all the time.
Yeah.
Usually they go the inflation route because you don't have to pass any legislation, you just print more money.
Yeah. But I think it's food for thought, okay? Tax planning mistake number 3 is the failure to set up an HSA account. This is quite frankly better than a retirement account. You put the money in, you get a tax deduction for it. You can invest it and earn dividend. You can invest it in the stock market over long term. When you take the money out, you pay no tax. Unlike a retirement account where it's a deferral. So an HSA is really should be on the radar. This is something that can be done by April 15th. This does not have to be done by December 31st. You have to be in a high deductible plan. And when you get older, like you go on Medicare, you can't do it anymore. Okay? So there's all kinds of rules, but that's something that's overlooked. I strongly recommend. I look at that for all my clients. You need an HSA, and you should have that as part of your retirement strategy or investment strategy. Even if, in fact, let's say you say, I can't afford to put it in. I can't afford to leave money invested. Well, set up an HSA because that's what it's intended for. You put the money in and take it right back out and pay the medical bill 30 days later. You get a tax deduction for it. You don't use an HSA, you use an after-tax dollars to pay your co-pays or your deductibles. So it's a no-brainer if you understand that even if you can't put the money in to invest long-term, you should put it in just to roll it forward. You'd put money in and then you take the money out to pay the bill. Okay? You get your tax deduction. And for a married couple, it's over $6,500. It's nice. A single person around $3,500. Yes.
You can take it. I think you do have to roll it into another qualified account, don't you, to avoid taxes.
Well, no, I'm saying you can. When you put money into an HSA, when you take it out to pay medical expenses, it's no problem.
Well, I'm now on
Okay.
TRICARE, and so I had an HSA. It was like 11, 12. I was using it like a retirement account. I actually just transferred it right into my self-directed IRA, and so there are no taxes.
Well, and they probably would look at that. The point about that is there's different tax rules on that. If you put it into an IRA, even if you do a non-deductible IRA, you still get. So there's some issues I would have. That's another issue. If you roll, if you start doing non-deductibles and put it into the same account, it gets very complicated. Those computations.
Deductible and
Yeah. So that, and people miss that all the time. Tax preparers screw that up all the time. Okay, so I tend to try to keep my non-deductible and my deductible accounts separate. Okay, and not commingle them. And good questions. Any other questions? All right. Tax planning mistake number 4, failure to keep adequate receipts for your business expenses. And people fear an IRS audit. And I can tell you, if you have a receipt and you have proof of payment, no question. I go through audits all the time. There's nothing to fear in an IRS audit if you have documentation. What does that mean? A credit card is only a receipt of payment. You need to keep your credit card receipts of the actual invoices because they have to make sure that payment was in fact for a business expense and not a personal expense. It might be Office Depot, it might be Kroger's. So a lot of times your expenses may in fact be personal, that you're mixing it up, and the IRS wants to see each of those receipts. Okay? And as far as fearing an IRS audit, we have now, and this is another thing, people use electronic on their bank accounts, so you have bank statements, and the canceled checks are okay. In other words, you don't have a canceled check anymore. Okay? But if you're a business owner, if you're an individual that's concerned about an IRS audit, I pay the extra. I get a with my bank statement, I get a copy of every check that goes through my account, and my law firm account, my CPA account, and my personal account. Because if I get audited, I have to go back years potentially and get all those bank statements, and it takes time consuming and it's very costly. So if you are concerned about the IRS and you are taking business expense deductions, you do in fact want to get copies, electronic copies with your bank statement. Just do that. Or if you do it, you can go into your system, you can print them off. I'm just too lazy to do that. I just pay a couple bucks and they do it for me. Okay? So I don't want you to fear an IRS audit. We want to maximize our deductions. We want to claim everything we can, and we want to keep receipts. Tax planning mistake number 5 is it's fair to maximize your business expenses for automobile, and also travel expenses and your home office deduction. These are all very legitimate business expenses. And in fact, it's something that if you have an automobile, the first question is how many miles do you drive? Because once you start your method on a car, you have to keep it the whole period you own the car. And if you have a lot of miles, then typically you want to use the mileage method, 54 cents a mile, you get a tax deduction. Wow, 30,000 miles is a tax deduction of $15,000. You save $5,000 in taxes if you're in a 1/3 tax bracket. That's not bad. If you have low miles, then you want to use the actual method. For travel expenses, there's per diem allowances, so there's some issues there that you can use the per diem allowance as a business owner for meals and incidentals out of town, but for travel, for lodging, you have to use the actual receipts. You're not allowed to use the per diem amount if you're a business owner and traveling. They want to see the actual receipts. And so, in the home office, don't shy away from the home office. Okay, it's a legitimate deduction. They simplified the rules. You can deduct $5 a square foot up to 300 square foot. It's a $1,500 deduction. It's a no-brainer. Now you have to use the office exclusively for your business. I just had an audit last year, and unfortunately, the lady got separated. And I think the audit caused part of that, quite frankly. But the agent actually wanted to go to her home and see the home office. And I said, oh, she's separated. She moved out of the house. It's not there anymore. And I really, it's a psychology game. When you do an IRS audit, you don't have your client talk to the IRS at all, okay? And I try to, get to know the agent and you try to paint a story you try to have some type of empathy for the client, okay? True stories. And so this lady didn't have all of her receipts. She didn't have all the bank statements, but she explained how she lost it on her phone. She's a tech person, this and that, And so, so we didn't have all the receipts, right? We didn't have all the expenses documented, right? And he couldn't see the home office, right? But she was in the middle of divorce, the poor lady, oh my gosh, look what you did, And it was a no change. True story, okay? I just had another client, December 1st, met with the IRS. Now, he went on his own. He was in his wheelchair with Parkinson's disease. He's got 2 years to live. No change. It was resolved that day. So, the IRS, what I'm trying to say, the IRS, they're human people, okay? And they do take that into consideration, okay? That particular client, the books were a mess. Nothing balanced. Seriously. That's why I got pulled for an audit. I mean, it really was, so. I'm just trying to say that, that's my experience with the IRS. Don't fear the IRS. Well, unless you're really cooking the books. Yes, you should be afraid. Okay. Any other questions before we move on? Tax planning mistake number 7. Failure to use the proper tax entity to maximize your income tax savings. The biggest mistake is the failure to maximize, the Social Security tax savings you can have with an S corporation. And that was the example I gave you where I have the client that making $150,000, $200,000, his salary is $50,000. And the IRS, if you pay a reasonable salary, then he's avoiding Social Security taxes. Now, there's a caveat here, okay? You have to pay a reasonable salary. And so in this particular situation, normally if you're the sole person, I can tell you, if he got audited, he's playing the audit lottery. They would say anything you earn is compensation. Okay? But they can get under the radar, okay? But the other point about this is that, his salary is $60,000, so let's say it was $130,000, that's around $70,000 that he's saving Social Security taxes because he's got an S corporation. This is why small business people use an S corporation. So 15% of $70,000, he's saving $10,000 in Social Security taxes. You know what I tell the client to do? Use that money to put it into a retirement account. Okay? I'm not out there just to save taxes, but I'm there to do the right thing for my client. I want them to be putting that money away and not just blowing it. I want them to put it into a tax deductible account because it will have an impact on their Social Security benefit. Now, Social Security is a 35-year average, your benefit is, so a couple years I'm not that concerned about. If somebody's starting a business, they might, quite frankly, not invest it because they need it to start up their business. And quite frankly, that's probably a really good investment. I know from personal experience, where I started with my business 25 years ago. And you'll find in my story that I doubled my business in 3 years. I doubled it in 3 years. I doubled it in 4 years. So from 1993 to 2003, I took my business from a $100,000 a year business to a $1 million business when the recession hit. I should mention that Amy is the attorney in my office. There in the green. There's Amy, and Kurt's the other attorney in my office. But Amy and I, back in 2008 when the recession hit, all my tax clients were going bankrupt. All my home builders, all my contractors, all my small business people were saying, Bill, we can't afford, and when you're losing money, There's no money to spend for tax planning. There's nothing to plan for. They're not paying any taxes, okay? So we focused on growing the law firm business, and Amy and I doubled it from 2009 to 2013, and now we've tripled it since then. It's all about sales and marketing for a small business, quite frankly. I should be more of a salesperson than a technical person, but that's what makes me kind of unique, because I have that blend, and that's what makes the business successful. Normally you have to have in a business a salesperson to bring the business in. You have to have good people doing the work, and quite frankly that is part of my success too, because Kurt and Amy actually do all the work, and they like their billing rates a lot better than mine. Okay, so it's a win-win for everybody. Okay, I'm able to leverage myself. Yes.
My accountant's been talking to me for my clients, but also maybe for my own personal situation, about the hot new thing right now is to become an LLC but choose to take the sub-S election and choose to be taxed that way.
Yes.
What are your opinions or your thoughts on that, rather than being just a standard S corp?
Well, what he's saying about is that as a financial advisor, you can set up your business in an LLC, and that is you are allowed to do that, and you can elect S corporation, okay, and then you can do the strategy we're talking about, okay. The point about that is I think it's very aggressive, because unless you have a staff working for you, that's going to be the key. Because if you're a one-person operation, the IRS will take the position with any personal service that anything you earn should be your compensation. Unless you got capital employed in the business, which typically you don't have a lot of capital in your business, you know, where you're in equipment or inventory, you don't have that. You're not a manufacturer. You don't have a lot of fixed assets in your company. So, like for my example too, potentially you're okay because you got, I got 2 attorneys. I could do that, but in my situation, I have to have a business that's not very profitable to do that. If I'm very successful, how do I justify paying myself a $50,000 salary? You know, it doesn't fly. That's the other issue too that you got. Like this one person that's a consultant, I told him that he's playing the audit lottery there. It doesn't mean you don't do it, but you need to understand the ramifications if you get caught. That's just the beginning, because we might have some fun with this if the new law passes. I'm going to cover that when we get to the next outline. Because when the new law passes, they've got all kinds of rules, because they're talking about lowering the tax rate for business owners to pass-through entities to 25%. And they got all kinds of rules as to how much you should pay in compensation to the owner and what can qualify for the lower tax rate. And that ties in also with what you can do with Social Security taxes. So it depends on whether the House or Senate version get passed as to what really is going to happen next year. So I'm going to cover that again, but the important point there is that if you're going to do something next year, you have until March 15th to make an S election. So we have the first 2.5 months of next year to seriously evaluate all of our business owners to determine whether or not their choice of entity is an appropriate entity. Okay? So that's a very good point. It's what I call a very gray area, and depending upon whether the House or Senate version gets passed, it's going to get very complicated.
But with dedicated staff people that you're paying, it's a more likely thing to go that path.
Exactly, because then you can justify that the business is based upon the not just your efforts, but you have a team of people, and so you're able to leverage yourself. So some of the profits relate to the work that your people are doing. However, I'm going to go ahead and interject this now. I'll cover it in the outline again. The rule they got, though, is I think it's the Senate version. I get them mixed up. It's one of the versions. That if one person is the primary person for bringing the business in, then it doesn't count. Okay, so they have a special rule they've developed that's intended to shoot that down, and I have to take the position that one of my other, for example, Amy and Kurt bring in business, so I can take the position that I'm not although I am the primary person bringing in business, that is a substantial factor in my business that they are paid, and I pay them a 25% bonus for anything they bring in, so it's measurable. It's not just smoke and mirrors, okay? So it's going to get complicated, but it is something you'll have to take a look at when the new rules come out. And that's going to be one of the other points I bring up for the year-end tax planning. Okay, good question.
Thank you.
Okay. Any other questions? Are we having fun? It is fun. I'm having fun, I got to tell you. But anyway, tax planning, or year-end planning mistake number 8 is fair to maximize your tax savings for using the cash basis of accounting. And so the cash basis of accounting, a lot of businesses can use it. And there's a cutoff up to $5 million currently that you're thrown off the cash basis of accounting. Interesting. The new law, Congress, House and Senate version, they're going to change that limit to 15 million or 25 million. We don't know where it's going to shake out. Interesting, huh? I like the cash basis of accounting because what it says, if you have a client, a business that has receivables, that's income that you haven't collected. So under the cash basis of accounting, you only recognize in income the cash you collect. Okay? Under the cash basis of accounting, you can prepay expenses up to 8.5 months of the next year. So that if your accrual basis, that's called a prepaid expense and it's not deductible because you got to match the revenue and expense on accrual basis. So the cash basis of accounting is a very effective tool for professional services companies, businesses that do not sell product or inventory. If you have inventory, you're supposed to be on the accrual basis, but there's an exception for that. If your sales are under $1 million, if you're really small, you can be on the cash basis and not have to report tax on your accounts receivable. Okay? But your accounts payable is not deductible as it relates to the inventory and the product that you're selling. So it gets complicated, but it's fun for the accountants because what we're doing right now, this is a very effective tool that we expect tax rates to be lower next year. Okay? We don't know how much. Maybe it's 3 or 4%. Okay? Now, I thought they were going to maybe do something this year. I was fooled after the election. So last year in December, I loaded up on cash basis. I paid probably around $50,000 of advertising. I paid my advertising 6 months ahead of time into 17, and I got to do it again this year, quite frankly. That's the problem you get. Once you do it, you keep doing it every year. But, that was a big tax deduction I got in 16, and I got to keep doing it this year, so I've done it again this year. So I'm allowed to prepay expenses as a business owner. I'm a sole proprietor. I'm not an S corp because my income is too high. I can't justify so there's no really big benefit to me. When you start looking at some of the numbers, because I'd only be saving 3% Social Security taxes, and there's other factors that go into that. So, but you can talk to your CPA and your tax advisor, to figure out what should you do to defer income and accelerate expenses if you're a cash basis taxpayer. That's the question. And you can prepay office expenses. You can buy equipment. You can buy stuff at the end of the year. You can do things. I had a guy last year that went out and bought a vehicle, $50,000 car. He got to write off $25,000. That was, and so that was a nice deduction. And then you could do bonus depreciation. So the remaining 25, you got to write off $12,500. So while he couldn't take depreciation on the other $12,500, he got a tax write-off of $37,500 and saved $10,000 in taxes. We're a little bit more than that. So, these are things that can be done at the end of the year under the rules today, that someone could go out and buy a nice, that the key with that, it has to be a large vehicle that the gross vehicle weight has to be over 6,000 pounds. So it's got to be a real biggie, big SUV or something. But that's what he got for his wife and the kids, and she's in the business, and so they're using it in the business. So I think that's, there's some really good planning to do at the end of the year if you're a cash basis taxpayer. Okay? So, moving on to tax planning mistake number 9. I don't know how we're doing with time. How are we doing? What time is it? 9:15. Oh, okay. We still got 45 minutes. Got 45 minutes. When you're having such a great time flying, time flies. It's like, oh my gosh, I can't believe it. Okay. Number 9 is the failure to use the tax depreciation methods to maximize tax savings. Now, this has a little bit of different twist. And I find this with so many clients. CPAs don't think sometimes. Seriously. So they're always out there trying to maximize your tax depreciation. I've had clients where they've maximized the tax depreciation, and they were minimizing the tax benefit. The clients were not, they had so much of a tax write-off, they weren't even using their itemized deductions on their 1040 on the pass-through entity. So that you can go out and really, do a great job, but I had some clients that there's a balance there. And my point is that we want to use the lower tax brackets sometimes, the 10% bracket, the 15% bracket, and some businesses that have depreciation, we don't want to get too aggressive. Because when you sell the asset, if it has some residual value, you have to pay tax maybe at a higher rate, okay? So there's some planning that goes into determining how aggressive you want to be and how much you write off your assets if you have a lot of fixed assets, equipment, vehicles, manufacturers, that type of thing. And I had a client of God. I had a client that I picked up. He had pods, and he could write them all off. So his accountant didn't do him any favor because he had no profit in his business, and his losses sheltered all of his income that he had. So he did get the benefit of his itemized deductions, and he had around $40,000 in itemized deductions from charitable giving and other types of, real estate taxes that he wasn't getting the benefit for. So he appreciated when I said, well, no, we have to cut back and take straight line depreciation. So I want you to have some profit so you get to use up all your itemized deductions on your tax return. It's common sense. It's not that common. Okay? It really isn't. Okay? But people are just really, we're going to maximize your tax write-offs. They don't think. Okay? So that's what that message is about. It's about how to use tax depreciation methods to get the biggest bang for your buck, knowing you're going to have depreciation recapture when you sell the asset. Okay? Any questions? Tax planning mistake number 10, failure to reimburse employees for business expenses using an accountable expense reimbursement plan, or dependent care, or medical premiums, or medical expenses on a pre-tax basis. These are tools that you use to try to help your employees get benefits on a pre-tax basis, things that they're ordinarily paying for. And so that we have clients that if they have, this started out when I first got out of college and I was an accountant. I had a $300 a month car allowance. It was tax-free. I saved income taxes on it. I saved Social Security taxes on it. The employer didn't have to pay Social Security taxes. That's a long time ago. So now it's, yes.
These are W-2 employees, not 1099.
That's correct. Now the 1099 people would file a Schedule C and they write off their business expenses under Schedule C, or if they do an S corporation. And that's another important distinction I want to make. If you do become an S corporation and you're the owner of the business, you're now an employee. And it talks about unreimbursed employee business expenses. If you're an employee and you try to deduct it on your personal return, it's on Schedule A, and 2% of your income is non-deductible. You lose the deduction. If your income's $100,000, you lose $2,000 deduction. So, and for a business owner, then the message is you reimburse the expenses. The other thing I can tell you from the IRS standpoint, they're now taking the position in audit, because this gets flagged if you have a lot of unreimbursed employee business expenses, that the IRS is now taking the position that if you have a large deduction there and your company has a policy and they're not reimbursing you for those expenses, then it's not ordinary necessary business expense, it's not deductible. I had that in audit. That was a new thing that came up a few years ago. I was like, what? Just because the employer says I'm not going to reimburse you doesn't mean it's not ordinary and necessary, but that's their position. So if I'm a business owner, what do I want to do? I don't want to deduct that on my Schedule A. You need to know that S corporations are audited very few. Individual returns are audited a lot. And they go after specific deductions, and that's one. If that's on your, I had a client that he gave too much in charitable donations, $200,000. She got audited, but she had $200,000. She was very charitable. They couldn't believe it, but she was very charitable. So they'll flag different places. They really score your tax return. They score your Schedule C. I got a client, I just love telling stories because this is what happens, now. I have a client getting audited now. He did his taxes on his own, TurboTax. The IRS audited him. This is, he's got $1.8 million in income, and he's got in Schedule C.
TurboTax with $1.8 million?
Yeah. I'm gonna do his tax return this year. This is for 16. He's a contractor. He's a contractor, and so he had supplies of $473,000 on Schedule C that's usually your office supplies and stuff. It was $473,000, and he's got independent contractors, so he has labor on these jobs of $210,000. So the IRS is auditing those two numbers. He got flagged for an audit because they should have been in cost of goods sold. That's how I got flagged. You're a contractor. You have construction contracts, and then you have your cost of goods sold, and you have gross profit. He had $1.8 million of gross profit, but they didn't care. They said, "What's going on here?" So we're in the middle of an audit now, and guess what he's got to do? I just talked to the agent yesterday. This is going on right now. I had to give him a printout of the $473,000 of supplies. And he came back to me and says, "I want documentation for everything over $500. Oh yeah, and the IRS is they're unbelievable. They sent him a letter at the end of October. He didn't call me till the middle of November, and they wanted him to everything together by December 5th. I go, it's holidays, Thanksgiving, yeah. They says, okay, I said, can we do it the first week of January? He says, well, if we do it the first week of January, I'm going to give you a report, which he has now done because we couldn't do it December 5th, disallowed all the deductions. So I got a report from the IRS that he owes tax on $700,000 of income, okay? And he says, if you give me the information, then I'll adjust the report by the middle of January. The IRS is unbelievable now. It used to be we could stretch them out. They would give us a grant. They would do this, No, they have a timetable. They send you a letter. They want you to have information within 30 or 60 days. Now, what does that tell you need to do? You need to keep good records because if you're audited, they are not lenient at all. Okay? They're playing it by the book. So this stuff goes on. It's like, oh my gosh, So fortunately, I think we're going to be okay, because it's going to be complicated. And just even accountable expense reimbursement plan is what a company does. That has to be a written plan. You have to have a written plan to do that. But if you do that, then the company can reimburse employees for business expenses. Yes, sir.
Has your experience on the charitable donations? I'm very involved with my church, and so I've got quite a few clients in that setting. Obviously, tithing is an important thing if you're, spiritually minded. Does the IRS, take that in consideration that most people or a lot of people in that setting are trying to reach that 10% number? That 200,000, is obviously a very, very big number. That person would need $2 million of income, but have you seen, in your experience, that been taken into consideration?
The IRS scores the tax returns. Now, the thing I would tell you is, because I've been doing this for 40 years, people really don't give. It's really a flag, even at 10%. And I even talk to people that you better, and actually you got to understand the rules. The question here relates to, if you have charitable donations, and does the IRS take into consideration that, well, people tithe, so they should, if it's 10% of your income, it shouldn't be a problem. My point is that's the exception, not the norm. So when they score the tax returns, it's flagged out because there are a few people that do that, okay? But it doesn't mean that everybody that has that's going to get audited. They usually then have a scale when it's well over 10%. Those are the ones that get flagged, quite frankly. Okay, but it is something, yes.
So do they also look at several years to see, is there a pattern of giving to these same organizations and then all of a sudden a spike in something that they've never given to?
They don't do several years. Usually it's the prior year. So they'll look at your Schedule C and see if there's significant differences. And that's what gets flagged. So I have had that come up in discussion with an agent also, okay? But I want to go back with charitable giving. One thing you got to be careful of, you need a receipt from the charitable organization before you file your tax return. If you're audited and you get a receipt and you didn't have it dated before your tax return, it is disallowed. And there have already been court cases on that, yes.
What about if you have canceled checks? Obviously, that would be just as good, right? Like, in other words, some churches don't give out receipts anymore. I know they're required to if it's over a certain amount, but let's say for whatever reason they don't. If you have canceled checks, that should be sufficient, right?
No.
And why would that not?
They want a receipt from the organization. And that's not, the canceled check doesn't count towards the receipt. They don't know if it was for something else.
Churches don't,
Yeah. They're
they
not,
have the total contributions, but they don't divvy it out by person anymore. And then the other twist to all that is if somebody gives, like a gift of stock, obviously they have the receipt of where it got journaled out of their brokerage into the church's brokerage. Because I do a lot of that with my,
Right.
I'm a broker. And, you know, I always tell people, hey, if you get audited, let me know, because we have a paper trail of where your stock got journaled into
Yeah.
the church's account.
Yeah.
And that would be sufficient. Now, none of these people have gotten audited before, but wouldn't that,
You need
the
a-
church doesn't know it's an anonymous gift, so the church can't issue a receipt.
they need a written acknowledgement. That's the tax
So
law.
the
A written, a
would
confirmation
suffice.
has to come, well, you have to have a letter from the organization. The fact that you have a receipt that shows proof of payment is not good enough.
But the
cancel
church
check.
could write a letter at that time.
Oh, yeah, right, exactly, that's what you want. Yes, exactly. Exactly, yes, yes. And in fact, if they're not keeping it, if they're not keeping records, you keep track of your checks, present them to the church and say, give me a letter,
Right.
you know, that says that here's
It's got to
my,
be contemporaneous, so that means it has to be somewhere around that year. or-
oh, yeah, annually, you got to do it before you file your tax return.
When you get audited.
Before you file your tax
The
return,
church isn't going to write a letter for every single person that gave money.
well,
actually
guess what?
do.
Yeah, they're required to under the tax law, or you lose your deduction. You're playing the audit lottery. Yes, that's what I'm trying to say. Yep, the rules changed.
Receipts, but I've not heard of a letter.
Yeah, year end, usually every charity we give to, we get a letter from every one of them.
Oh, yeah, very much so.
Gave X amount.
That is the tax law. It's a written acknowledgement, you know, where you might have proof of payment, but that's the law. Well, there might be a de minimis under $250. I mean, there are some rules if it's under $250. Yes, yeah. If it's under $250, then they don't require. I think there's an exception for that. Okay. So this is all kinds of fun, you know. One thing that I forgot that I think I skipped over was the classification of an independent contractor. That was number 6, and I have a lot of documentation of what the IRS looks at to determine whether or not an employee is an independent contractor for a business owner. And it's very important, okay? It's very important to make the proper determination. And I think when you look at the handout, there's a recap at the bottom of the page on page 16 of 20. And they look at the right to control or the right to direct. And they look at behavioral control, financial control, and the relationship of the parties. Okay? So I gave you this information, and I got to tell you, this is a major issue because if you are a business owner and the IRS determines that that person should have been an employee, or the Bureau of Workers' Compensation, or the Bureau of Unemployment, you are liable for the taxes you should have withheld and paid, personally too. Okay? So it's a big issue. This is just the Social Security taxes, it's the income taxes you should have withheld from employees. And how does this happen usually? Well, what happens is typically someone gets hurt on the job and they go to unemployment, or they go to workers' comp. Workers' comp makes a determination, were they an employee? If they were, then all of a sudden you're in big doo-doo. And then, and this happened with a client. For years, he had all of his 10 employees get 1099s. And he hired this person, and he worked for 3 months and left. And he went down to the unemployment office. Where's my unemployment? Unemployment came in and looked at everybody. He had a 3-page questionnaire. He had to look at what each person did and whether they were trying to determine each person, whether they're an employee or not, determined that everybody was an employee. They got a $26,000 assessment, okay, going back 3 or 4 years. They actually, the last couple of years, they bumped up the unemployment rate to 10% of $8,000, so it was like $1,000 a year plus interest and penalties. You know, I mean, that's how this thing got really jacked up. And I haven't heard the latest on, that was a year ago, they were fighting it. The attorney brought me in to give him some counsel on how to try to, you know, focus on the factors and what, you know, what you could do to try to prevail, because the problem was, it rolls, because if unemployment then federal unemployment picks it up, and then you know, it's a nightmare. My recommendation, there's a simple solution to this. And normally I find that if you have an employee, you're paying their Social Security taxes and unemployment taxes and workers' comp, so you can factor in that into their different industries. That's how they get them too. So I just want to mention that that is something for business owners that I think is an important consideration. And there are some solutions if you work with your CPA, your attorney, to try to identify. Because if you do have an independent contractor, then you really want to dot your I's and cross your T's and make sure that they are an independent contractor. You want to make sure that they're carrying their own insurance. They have to have some type of risk. You want them to own the equipment. You don't want them working in your office using your equipment. Okay? These are the fine things that you can do, and you can have a written contract. And the contract isn't good by itself, because when you do get audited, they come in and say, okay, this is what the contract says. Now, what did you really do? Okay? It's not smoke and mirrors. Okay? You can't get away with that. They will interview the employees individually. I've had clients that have had to go through that. Okay? So, take a breather here for a second. That's
Really
the.
classify as part-time employees then?
Pardon?
What if you have employees that are part-time?
If you control them, they're part-time employees. You have to cover them as you have to cover their payroll taxes.
Regardless of how many hours,
There's no de minimis. Unfortunately. Because the problem is when you got payroll, if say you're just a one-person shop and you're hiring your first employee, I had to do this with a client, it's like, it costs you money. To do the payroll for one employee is somewhere around $1,500 a year. One employee, the Social Security taxes, you got that, but then you also got the unemployment taxes, you got the workers' compensation. You don't have a choice. It's not good. Okay.
Hey, Bill?
Yes.
I've got a client, and she's in sales, and she works for a large company, and the company gives her a $300 car allowance every month, but it's included in her taxable income. And I don't understand why would a company do that? Why wouldn't that be a pre-tax to her?
The companies have policies that technically they assume the risk of whether or not that they'd have to oversee. She would have to submit, which I had to do when I had my $300 a month thing out of college, is I had to submit a weekly report or a monthly report of my miles and where I drove and everything else. So you have to submit a report, and they look at the cost of that as probably an administrative cost that it doesn't pay for them.
So it's the safest way for them to do it.
Safest way for them to do it. If they did not include it, then she would need to report to them the mileage, and then if it was fudged, the company would be held responsible, because when you have a car allowance like that, at the end of the year you're supposed to true it up and say how much documentation did you have. Like in that example, $300, $3,600 a year. Maybe you only had $3,000. Well, then you have to put into the payroll $600 in December.
Yeah, makes sense.
Yeah. So that might be what it's about, is administrative cost, that they just say we're not going to mess around with it. That I know it costs them 7.65% Social Security taxes, but the employee would really benefit from it even greater, because they would save income taxes and Social Security taxes. Okay. Any other questions? This is wide open. Oh, okay. Yes.
Yeah, a question about earned income for retirement plan purposes.
Yes.
We have a CPA that gives us a lot of referrals, but he always pushes like these sole proprietors into doing an LLC. My understanding is the sole proprietor can have guaranteed payments, guaranteed withdrawals, right? And that qualifies for a plan purpose. Does that sound correct?
Repeat that. They can have guaranteed payments is a tax term for partnerships.
Okay, so that only applies to partners.
Yeah, guaranteed payments. Now, if you are a sole proprietor, we call them drawals. A sole proprietor is taxed on all of their earnings for Social Security tax purposes. Okay. When you have a partnership, there's some special rules that apply to guaranteed payments, because if you're a partner in a partnership, an owner of the partnership, you are not on the payroll. You're not an employee for federal tax purposes. You're a partner. And on the partnership tax return, because partners may not be paid the same proportionate to ownership, that's treated as if you're paying that partner a salary, and that's how it's deducted on the partnership return. And then that partner picks up the guaranteed payment as additional income in addition to their share of the partnership profits. And yes, Does that answer your question?
Well, it does, but help me out. So when I have a sole proprietor and they say, oh, we don't want to go through setting up an LLC and such, we just want a retirement plan, they can still essentially show income?
This is interesting. Let me try to clarify this. Attorneys and CPAs do not understand limited liability companies. Okay? So, not all of you have a book, but in the middle of this book is, right in the middle page, is a thing about the different entities that we have. And I think it's important to understand what the entities are, okay? Limited liabilities came about around 20 years ago when they wanted to provide limited liability to sole proprietors and partnerships. For tax purposes, you can take your sole proprietorship and form an LLC, a limited liability company. Or you can take your partnership and put it into an LLC, and you get, under state law, asset protection that you're not liable for everything that happens with your business, unless you're personally negligent, like a doctor, or unless you have personal negligence. So I even say, even if you have a limited liability company, it protects you from other liability, but not your personal negligence, okay? So for tax purposes, it's a no-brainer that if you have any liability in your business at all, you should probably be a limited liability company. And I'm a limited liability company, okay? But I'm just a sole proprietorship. Or if I had partners, it'd just be a partnership, okay? Then the law has evolved that they simplified things, that if you are a limited liability company, you have the ability to make an election to be taxed as a S corporation or a C corporation. Those are the two other choices. The C corporation is for a business owner, and that's one of the things that I didn't cover that, but I'm going to cover why you would, under the law today, you'd want to be a C corporation. A C corporation is taxed at 35%. You've been hearing how C corporations, businesses, are taxed at 35%. If you are a small business, we've been using a C corporation, but there aren't that many around, quite frankly, is that you can have around $50,000 of profit in your C corporation and only pay tax at 15%. It's a tax shelter. You got to have the right company, the right situation to do that. So what you do is that you pay a salary to the owner out, and as long as it's a reasonable salary, as long as the business isn't too profitable, that you can pay out, that's what we try to do. We try to adjust the owner compensation to keep the profits at $50,000. That's the ideal tax savings, because the owner doesn't have to pay Social Security taxes, doesn't have to pay income taxes, and you're only taxed at 15%. And in Ohio, there's no tax. In Kentucky, you pay some tax on state, on your corporation. So, but what happens is, if you go above that, then from 50 to 75,000, you're taxed at 25%, and then it goes up, and over 100,000, you're taxed at 39%. So the way a C corporation works out, when your income gets up to $338,000, you're paying a flat 35% on all your profits. It's a complex equation, okay? My point, though, is that a C corporation, can be a valuable tool, okay? Now the question is going to be, because now C corporations, as I'm indicating, if you're a small business and your income is over $100,000, you're really getting taxed at 39% to recoup the lower tax rates that you had on the first $100,000. Under the new law, they're talking about reducing the maximum tax rate to C corporations to 20%, not 35%. Interesting. We have some S corporations that might want to become a C corporation next year. This is a great segue to the year-end tax planning to talk about what's going on with the C corporation and the new tax law. So the other thing that's bad about a C corporation, we got to take it in consideration, that you might have heard about, is that if you have a C corporation, you have a double tax, because down the road, if you liquidate the company, then you have to pay capital gain tax on the profit that you've accumulated in the company that got sheltered in lower tax rates. However, there's always the planning opportunity that you can elect S corporation, and after 5 years, they made that law permanent, that you could run the C corporation for 20 years, and when you're getting ready to sell the business as a business owner, then you would make an election to be taxed as an S corporation, convert to an S corporation, and after 5 years, there'd be no double tax on the gain on the sale of the assets. Okay? And also, there's another important consideration here too. A C corporation does not get the special capital gain rate at 15 or 20%. So if I'm a C corporation and I sell my assets, my C corporation pays tax on 35%, not 15 or 20%. The 20% capital gain rate doesn't kick in until, under current law, until you're married, almost $500,000 of income, single, $400, $450. I mean, you got to have a huge amount of income before you start getting taxed at 20% capital gain rate. Okay, that's in the tables here too. There's a chapter in this tax guide on capital gains and stuff. But so it's really going to be some really good planning here. That's one of my tips that I'm just going ahead and going into the next outline. Great segue. This thing is so dang on complicated, it's unbelievable, because we don't know what some businesses may or may not qualify for the lower rate if you're an S corporation, a pass-through entity. So that becomes the issue. And should you be a C corporation? Okay. It depends on how profitable your company is, because keep in mind, Ohio gets it really complicated from a state tax standpoint. A C corporation doesn't pay anything except the commercial activity tax. So you pay the commercial activity tax in Ohio regardless of what entity you are, okay? And that's not that much for most businesses. It can be for bigger companies. So it's called the Ohio Commercial Activity Tax, if you haven't heard about that. So a corporation in Kentucky, though, pays corporate income taxes at maybe 5 or 6% on its profits. But you get to do the apportionment. And it depends if your business is all in Kentucky and interstate and all that other stuff that goes with it. So it is going to be an important consideration when the law is passed that we're going to have to reevaluate every entity that we have to determine, is that the proper entity that they need to be? Should they continue to be a sole proprietorship? Should they continue to be an S corporation, a partnership? Or should they be a C corporation? Because in a way, it's like, well, if I can't, if I'm a business owner and I'm getting taxed at, my tax rate might be 25, 35, in that 25, 35% bracket, and I can get taxed at 20% on my profits. But the problem is you got to keep the money in the business. But sometimes you can use a C corporation as a tax shelter. People don't realize that a C corporation is not really bad. You can accumulate money in a C corporation. You can invest in stocks in the C corporation. And the dividends received deduction is 85%. So you don't have to pay tax on the dividends that you get. But unfortunately, when you sell it, it is subject to ordinary tax rates. But if the maximum tax rate is 20%, I don't know if they're going to do anything for passive income in a C corporation with that 20% rate. So we're going to have to do some planning the first 2.5 months of the year to evaluate, because March 15th is the last day to terminate your S election to become a C Corp if you wanted to. Or March 15th is the first day, is the last day for 18 for you to make an S election if you wanted to become an S corporation. So this area is going to be really interesting, the twists and the turns. And they have different, House and Senate have different versions, so we don't really know for this, trying to determine, whether pass-through entities are going to be subject to the 25% tax rate. So you got a 20% C Corp rate, a 25% pass-through rate on profits, but they may require owners to pay tax on ordinary income on not just their wages, but also the profits. They're going to have special rules that says, yes.
Segueing to the S Corp stuff that you were talking about.
Yes.
Do you typically recommend to your clients that are S Corp a ratio? If they know kind of a realm of where their income is, whatever your gross profits are, do we want X percentage to be paid to you in salary as an S Corp owner versus what you allow to pass through the K1?
Actually, I do not. What I do is I use this quite frankly for, I find the thing that splits up businesses that have partners, because a lot of companies have more than one owner, is the splitting up of the pie. I have this going on right now with a client. He's terminating his company because he was giving his partner 50% compensation, 50% of the profits, And last year, they had $800,000 of revenue, and his partner brought in $40,000. The only thing his partner did was the books and the internet. And he gave up all that money, and he's terminating his partnership December 31st. I'm working with him on that. His partner was in Texas, and he's going to be relocating the business here to Ohio. And so I raised the question is, what would it cost to replace you if you had to replace yourself? That really is the question you should be asking that would be defensible with the IRS. If you had to replace yourself, okay, to operate and do what you do, how much would you have to pay? I think that's important when you do buy-sell agreements with partners, okay? Because I always try to put a clause in there that the partnership will pay reasonable compensation for the services performed. I cannot define it because I think it's a moving target. I think it's very important. It's what splits up partnerships all the time. If you're not fair with each other on the money, it's not if you're going to get divorced, it's just a question of when. So I think compensation is an important consideration. And so what I would do with that then is focus on what would the person have to pay to replace him, and that would be defensible with the IRS, I believe. Because you've identified duties, responsibilities, and comparing to what other people are paid in the company. Okay? Time is just flying. It's so good. Yes, we have another question.
Is there any language you've seen regarding fresh IRAs or any changes regarding that?
I'm trying to remember and I can't. Actually, I have two outlines in your handout that have the comparison. Somebody might want to look at that one. I got 10 minutes to wrap up the year-end tax planning, so I got kind of into this thing. But that was one of the important considerations. But maybe somebody might want to check that in one of those outlines. Yes?
Yeah, I haven't seen anything that would change the R&D requirements, which is what those are based on.
Okay.
Whatever.
But let's go to the next outline, the year-end tax planning mistakes. This is what you need to do this year. And actually, half of these things were covered in the first outline. So that way, I only have to cover 5 out of the 10. I'm going to brush over the other ones. This is important. I put this on the front page for this presentation because you probably have already heard that beginning in January, when you sell stock, you got to use FIFO for determining what stock basis is to be allocated to the stock that's being sold. So if people need to rebalance their portfolios, you're allowed to select, if you're trying to rebalance your portfolio because of the market going up, you need to do it maybe in December, and you can pick stock that has high basis that you might have is the most recent stock you've purchased if you have a certain stock that you have multiple purchases of. So that's what this is intended to say, that you should do some planning over the next 2 weeks. And you're also harvesting losses too, quite frankly. So again, you have the choice there. If you know, how do I maximize my loss? How do I rebalance my portfolio and minimize the taxes on the rebalancing of your portfolio? Any questions? We're kind of wrapping this thing up. You got to look at alternative minimum tax. I got a comment on that. That's the next page. Because if you're on alternative minimum tax, you may not get a benefit for paying the tax this year. But if you are an alternative minimum tax, you may want to accelerate some income into this year because it may not get taxed. So you got to work with your CPA to do some computations that if a person is an alternative minimum tax, you have the ability to increase your regular tax liability potentially and not have to pay extra tax on that income. To me, you don't have anything much to lose unless you think your business is going to tank. But some people have an extraordinary bonus, extraordinary contract that they got. Things are changing, so they know that next year it's going to tank. So they really want to make sure they do their year-end tax planning to minimize their taxes this year. And then the choice of entity, that's number 5. I just talked about that. That's going to be huge to identify what are you going to be? What should you be next year? We don't know until we get the law, and you have until March 15th to make that decision. So that doesn't have to be done by year end, but you've got to get started on it in January. This is another thing, failure to review your divorce decree, and maybe you could prepay your alimony payments. People don't know this. Next year, alimony is not deductible. They changed the rules. There's a winner and a loser. The person who is receiving it doesn't have to pay tax on the income. The person that's paying it doesn't get a deduction. And I've even suggested, I don't know how this is going to shake out, could you somehow negotiate with the court and cause that because it was a change of circumstance, whether it would be a basis to get the divorce decree modified because of if you could show that the taxes were part of the consideration, and now they've been taken away because of the change in the tax law. Good luck on that one. Yes.
How much of divorce, like for 2018, would you deduct?
Well, I think if you look at your decree, because that could be an issue, is what I'm trying to say. If it's silent on the decree when it's paid, other than you're going to get paid, I think you have to look at the decree. I think at least 1 month. I think if you pay January, but I don't know how far you can take it. You have to look at your decree and talk with your attorney. To me, you have nothing to lose, everything to gain, because, again, it's. And what my suggestion in my outline: work with your ex-spouse and split the tax savings. Okay? Well, I'm just saying, Okay. That may not work. Okay. Number 3, failure to prepay your tax return preparation fees. You'll see a separate letter on this. The IRS has taken away the tax for tax preparation fees. So I sent a letter by pay me in December for the preparation of 2017, and maybe 18 if you want to, but that might be too aggressive. I don't know what the law is going to say. But at least I think they should be able to pay 17 in December. And I've asked this is kind of interesting, the timing of the deductions, and I have to pick up income. So I told them, mail is certified mail December 29th. You get the deduction in 17, and I get the income in 18 when I get the mail on January 2nd. So that's in my letter I sent out, okay? We got to use every angle we can, okay? This is really an important consideration. But I think the letter I gave you that outlines it as far as the change in the law for donations. The standard deduction for single is going to $12,000. Standard deduction for married is $24,000. A lot of people, they're taking away the state and local income tax deduction. The only thing you got left is mortgage interest. A lot of people don't have a lot of mortgage interest. And real estate taxes. What does that mean? Well, if you've been donating to the church $5,000 a year, you get no benefit next year because you get the standard deduction. What am I going to do? I've contacted the Greater Cincinnati Foundation. I'm going to put $25,000 into a donor-advised fund in December. I'll get a $25,000 deduction this year, charitable donation. I'll save $10,000 in taxes. I'm in Kentucky. In Ohio, you don't get to itemize your deductions, so you might only save $8,000 instead of $10,000. So this donor-advised fund is really an important consideration when you take into consideration that you're not going to, because of that larger standard deduction, they've eliminated the personal exemptions and all that stuff. You just get one standard deduction. So now what that means is that, you should consider the alternative, if you didn't do a donor advised fund, would be to start making a large donation directly to the charity. But in my situation, I'd rather spread it out over the next 5 years. I don't want to give them all that money all at once. I know we're wrapping up. We got a couple minutes. And I guess we're down to number 1. The fair cash basis taxpayers to defer income and accelerate expenses, and we did cover that in the other outline. So I hope you've enjoyed this morning. Taxes are fun. It's a great year. Ho ho ho! Congress has given us a great Christmas present, and it's the full employment law for CPAs and tax attorneys. Thank you for your attention. Thanks.